Go.
You're gonna see action first, I think it'll be better. That's much better. Good morning, everyone.
Good morning.
My name's Anthony Amaral. I'm on the chair for the, I'm on the Education Committee here at Kent, Washington. We have our normal lunch and learns on a monthly basis. This being one of them, which I get to finally present. And apparently I got to speak up, although not a lot of people have to tell me that much. I speak pretty loudly. I work for Washington Trust. I'm a loan officer for them. I've been in the industry for 30 years. I spent 20 of those years as an underwriter in the back room, observing different products and programs, as well as one of the concerns that I have, which is why I created this seminar specifically for condos. Washington Trust has been around for 225 years. We're the oldest community bank in the entire country. And being a community bank means we reinvest directly in our immediate communities, unlike the larger banks, which sort of more line their pockets in that avenue. We take our deposit accounts, we put it back into the community. We do such by a number of different programs, including the community lending programs, which are actually right in front of you all right now. There's a sheet directly there. They explain the 4 different community lending programs that we have, in addition to all the other programs. We're also Rhode Island Housing, Mass Housing, Connecticut Housing. It's in our immediate footprint. We do FHA, VA, USDA. We do DSCR, non-QM programs too as well. There's not anything that we don't handle. And we're a correspondent lender with about 90 other lenders in the country too as well. So we can try to find the overall best rate for an individual. In being a community bank, we also offer a program for portfolio, which is what we'll get into in this topic right here, because property, if it doesn't meet FHA or conventional requirements, it would need to be considered on a portfolio basis, and most local banks are usually the ones who handle those. Those community lending programs in front of you, great opportunity for people to save a lot, and actually, even as a selling realtor, some of you may have received an email from me about a property you listed recently. You know, Bill just had one, we just did. Where it fell in a specific census tract, and that census tract, we deemed it a low to moderate income area, and therefore those are the areas that we try to reinvest directly in. These programs consist of the Home Opportunity Program, for instance. One of my favorite ones is 2 loans, no PMI, so it's 80% first, 15% second on a multifamily, 17% second on a 1 to 2 unit. Both those mortgages are 30-year mortgages and rates in the 4s. It's about 1.25 lower than where conventional rates are at right now. Criteria fills into it. They have to be a first-time home buyer. They have to be buying in that specific census tract. So not every property falls into it, but the sheet also has every town or city in the state which has a census tract which would fit it. Not going to get it, unfortunately, in higher income areas. East Greenwich, for instance, doesn't have any census tract areas. Coventry doesn't. Warwick, West Warwick, that's pretty much our line. There's even one in Newport, the oldest counties in the area, has a census tract that fits that too as well. No PMI, rates in the 4s for it, so it could actually induce, a lot of times I'll send, like I told Bill, he could put it on his MLS listing that it actually meets criteria for that, could induce additional bids directly on the property, as they might not have, somebody might not have been able to afford it before because PMI played too much of a factor into their payments, or the rate being in the, FHA's in mid-5s right now, conventionals hovering around 6% on a well-qualified buyer. So these are much lower, can actually increase what they can afford on a monthly basis, allow them to have more bidding power when they go into sign. We also have the Isle of Brown, which is an old program which we do a matching grant for. So the minimum requirement for a first-time home buyer for conventional lending is 3%. So they would actually match, they only have to come up with 1.5, we come up with a grant for another 1.5 for them. And then we add for some closing cost reductions into their transactions. There's also the buyer's advantage and the Rhode Island advantage, which have their own unique opportunities as well. One of them actually has a capability for refinances for somebody who's in the census tract already, and they can refinance that property to actually get a better situation. So we've done this for 225 years. We're celebrating our 225th. The country's celebrating its 250th this year. So you see we've been around for a very long time. We're not that old stuffy bank that everybody assumes when they look at it, like, oh, I don't want to get something from the bank. This is an actual community lending bank. We're one of only 2 community lenders in the state overall. And like I said, we're the oldest in the country. So we've been doing this for a very long time. We look forward to help out our communities as much much as possible by being involved directly in offering financing options, which can help everybody across the board. That's not loud enough? All right, I'll get a speaker. Getting dry already, Linda. All right, so start with our presentation. Hope you enjoy lunch. How many people in the room have had a condo transaction? All right. How many people like them? Anybody ever had a property that was not warrantable or considered not warrantable? Created hardship directly for it? Down the road? Phil has to as well. Warrantability changes overall. The condo is considered one. Well, I gotta change pages. Sorry, I've got to do this. Condos have different mentalities directly to them. And then the reason why there's a big problem is when you buy a detached property, you own the entirety of the structure. But a condo has other issues directly for it because you're sharing common space, common walls, common grounds, and therefore it requires individuals to actually set up certain stopgaps in place so that the property doesn't depreciate in value. I can give you a prime example right now. Everybody remember the Florida condos that fell down 2 years ago now? Overall, deferred maintenance was the biggest problem now. So they weren't keeping up with the deferred maintenance. They weren't doing assessments, which kept it in there. And that can play into that condo would be deemed unwarrantable by anybody who was moving into it in the last several years. So they would have to probably have a more local lender to help them, a portfolio. And then it still comes on to the risk of the lender, whether they want to be invested directly in that. Because they have losses too. They're lending hundreds of thousands of dollars onto a property which could not be worth what it is. I don't know if anybody's paid attention to Florida condo values, but they've gone down the entire time. Unlike single family residences, which tend to have a nice steady stream, condos have a fluctuation massively. And it's not just the property, it's the condo association, what they have in place, the insurances, deferred maintenances that could be on it, litigation directly on them, all can play into it. And it can be a big issue down the road when you're trying to do that. And for the most part, you're not going to learn this until about 2 to 3 weeks into the transaction, unless you know beforehand that it is. Most realtors are aware of if a condo is FHA approved when it goes down. It's great. FHA approves the condo, has it for a certain amount of time, they've done all the due diligence on it, and they think it's perfectly fine. You can have no problem with that. Most FHA approved condo complexes are also conventionally approved too as well. Most. There's still going to be issues that can be overlooked, but it's going to be a little bit, it'll be an easier process. It's not something you have to worry about as much. But if you go through, which I can tell you right now, Rhode Island housing is not allowable, non-warrantable condos. So if it doesn't meet a criteria of the Fannie or Freddie form, which is the checklist directly for them, doesn't meet that, they're not going to lend that. So if that borrower's getting secondary financing, down payment assistance grants, down payment assistance loan, if they're doing any of those things, that could fall through, they'd have to go portfolio, and most lenders aren't going to offer that same local housing issue there.
Is that information available online, or is that just available to lenders as far as meeting or not meeting the Fannie Mae and Freddie Mac guidelines?
So process flow is a condo questionnaire in the process, right, in the transaction. We don't keep lists of them directly. Like if you were working with Washington Trust, for instance, I can call my condo associate, find out if we've done any validations in the last couple months. And they usually kept for about 60 to 90 days on how they are. Because things can change over time. Roof starts leaking, all of a sudden now you have deferred maintenance, so you have to keep up with it. The lender may have had in that project for a little while, they may not have. So going through the process is the only way to figure that out, because it has to be sent over to the condo associations. And nowadays, if anybody's dealt with the condo association, they're not so much fun overall. They basically are dot checkers for the most part. They don't know a lot. They go to the meetings, they do all the things with the individuals, they handle internal things, but they're not so aware when you're asking the right questions. Okay?
Anthony, I recall there used to be a list of condos that were approved by Fannie Mae.
FHA has it. Fannie Mae is, I don't know.
Oh, it's FHA that
FHA has
it.
a list.
I thought Fannie Mae had it.
FHA is a different process overall.
Oh, okay.
I haven't seen one in years, but I think it used to be at some point, but now that they're individualized, because the lenders are underwriting the file before they send it off. FHA is the backing and guideline rules directly for it. So they don't usually keep it, because then you'd have to get every lender to regulate and update that information. I'm not saying it's not there. I haven't utilized it in years. When I underwrote, there was one back in the day, because it was a whole different process.
Yeah.
And now it's individualized on the lender
All right.
to take it over.
Isn't there a national, or I don't know if it's national, but there's a registry online where you can go, I forget what the exact website is, but you can go and see if your condo community is FHA approved.
Yeah,
But
FHA
that
has a
doesn't mean it's
website.
warrantable.
FHA has a website. You can go right to FHA and actually look up condo associations
Okay.
and
then,
find out if it's approved or when it was approved, if it's expired, what the process flows.
and then my second question is, there are a lot of condos here in like downtown areas like East Greenwich, for example, where there's retail space on the bottom and some residential space on top, and those are not, do you know what the percent of residential space?
30.
So it has to be 30%
It has
or
to be
more?
30% or less resident, commercial.
30% or
Yeah,
less, alright, so
for-
70% more.
For conventional side. I actually have all that those stats actually right.
So if it's 50-50, that will, then it's not non-warrantable.
Sorry,
correct?
total commercial space cannot exceed 35%. Follows.
Okay,
35%.
35%.
Right, and that's for on a conventional basis. No more than 50 in the units can be 60 plus days delinquent on an HOA fee. Like, there's a lot of different things that can play into it. And you gotta remember, right? So if someone's not paying the HOA dues, now your reserves aren't there anymore. So if you have a problem, you can't fix it. Now the property's gonna depreciate in value because you have deferred maintenance, which is gonna come down directly for it. So it's not gonna be there. The investor's looking for something that, if you're staying on top, if you're maintaining it, focusing on the things that have to be done. This roof is 30 years old. We know we're gonna have to do it. We've seen it. Yeah, I know plenty of you have done a purchase where the buyers have to bring in $10,000 because that's the assessment that they're all collecting because the roof project's gonna be done the next 2 years. I have a condo right now in Lincoln that I live in, and they're redoing all the facades overall because termites, because it's all wooden facade. They're doing something else, so all those had to be broken down. And it's been there since I was a kid and went to high school in the same town. So it's, over time, these things change. You have to be mindful of it and pay attention. Like your budgeting and planning play into it massively. When you have snow removal, you have grass, common ground taken care of. All those things have on a regular basis. But then you have special assessments or capital improvements, like all directly on the property that's gonna have to be done down the road. And it has to be a time frame to maintain that. If it's not, it deteriorates. Property's gonna decline in value. Nobody's gonna wanna buy it overall because of that. Then you're gonna have financing issues too. Right? There's a lot of different things that can play into it. A lot of it's a yes and no answer. Investor occupancy in a unit can play it. Everybody know the 903s in Providence? We know those, right? So those used to be all rentals. Our company, Washington Trust, actually partnered with them to help that it was 100% investor occupied, right? Because they were renting to them, right? They were the owner of the building. They wanted to start subletting it out, selling certain units, so we allowed for it, and we took on a certain amount of those properties. You don't want to become divested in them too much, right? So if you have 100% and you finance all of them, the complex goes down, now you have all the losses. So if somebody wants to go in, they're gonna do a portion directly into it. They might not take on all of them. FHA actually has a requirement, they only do 10% of units. They won't finance more than 10% of the units in that property. They might be FHA approved, but if more than 10% are actually financed for them, they won't take it. Because they're now saturating their obligation, their costs that they're gonna have down the road. Any other questions from you?
So if we have a condo listing, do you recommend we get that questionnaire filled out before we list?
I don't know, you guys ever seen what it costs for a condo questionnaire for most of these associations? They're gonna pay $300 up front.
I mean, I would if to avoid this issue.
It is, and that's why we're doing this, so you can be more mindful, maybe even ask the questions beforehand, which gives you a better idea as you're going through it. This is meant to help you guys have a better understanding of potential problems in this category that could lead you to be able to streamline the process to be able to close down the road. And that's what we're looking at. And these aren't all the issues, but it's gonna show you a lot of the overalls and what the problem at the end is. So, as I said, condo is considered warrantable if it meets the standards set by Fannie and Freddie, the two main government-sponsored entities. Those are called GSEs. You'll see that term over and over again over the course of the presentation. Just easy to say that in Fannie, Freddie on a constant basis. As I said, it's important. The structure, health, and the entire development affects the risk for lenders and banking, since therefore lenders consider not just the credit and down payments of the borrowers, but also the condo's overall stability. The HOA of the condo community owns and maintains the common areas, buildings, exteriors, and most part up to the walls of each unit, impacting the lender's collateral. hence the lender's analysis of the buyers, the unit's structural integrity, and the condo and HOA financial health. Everybody's, just for a show of hands, have you ever heard HO6 policy? Everybody knows what that is? So there's two different insurance policies. I know Joe does. Two different HOA policies overall. So your complex is either going to be full coverage directly in, and then you just have to cover interior contents, which is really your couch, your love seat, your bed, stuff like that. Like a renter's policy, very much. An HO6 policy, most condos like this, studs in is your responsibility as the homeowner. So an insurance policy covers all that directly in. From the stud, if it burnt down, they would rebuild the box for you on the master policy. But the studs in policy, your insurance kicks in and covers the rest of that.
So I've seen some new construction condos lately where they're standalone condos,
Mhm.
like a single family house.
Yep.
And the HOA, like the homeowner is responsible for the entire structure.
Yeah, there's one I just did a couple months ago. There's two, right? And they were there. So it plays into the number of units will play into what the review requirements are for these, right? So anything 4 units or less, you actually just really need the master policy, and it doesn't really have to go through a whole condo questionnaire because most times it is the unit owners, those 4, that might be doing it. I just did one that had 2, and it was a big headache because we come down, they didn't have a correct master policy or internal content policy. So it wasn't covered correctly on one of the sellers was leaving, the other one, and they just sort of had, I don't know how they got around to it, and I think it just happened over time. And you don't have to escrow on anything that has less than 80% loan to value, right? So the lender's not going to be aware of it. They could have just changed it, stopped using it, and then just went to individual policies and called it a day. That would be it. And then it's the obligation of wherever the fire started or the roof leaked or whoever's came down to that. But in essence, that roof, even though it covers only one side of each unit, is the complexes, like the common area, the common wall in between, the roof, the grounds. I mean, grounds can be separated too, because you could have your both side lots as you do it. But it can be that it changed everything. They both had to get new insurances. The new buyer had to get it. The existing one had to change it. They had to have the master policy covering the other, or there was an agreement directly on it, and it has to be written. That who's required for what, how it's going to work. They didn't do that. But you don't necessarily need it. Condo reviews aren't necessary for the most part, unless there's a major concern or something that we're lacking on anything that's less than 4 units. And then from there, you have limited reviews, which are the condo questionnaire and then the insurance policy and maybe some other documents overall. That's the review on that. For anything, it comes down to investor occupancy, how you're buying it, if it's a first, second, third home, or the number of overall units in it. And then you have full reviews, which want meeting minutes, right, to see if there's any deferred maintenance, which is the biggest factor going on right now, and you'll see that in a minute. Or they want the bylaws. They need all the recorded docs, the decks recorded, so they can see all that and see what the requirements are. There are some that don't even allow it because the condo has right of first refusal, for instance. That could be an issue, right? So they have right of first refusal, which means they can buy back units. Now they have more than a couple of units overall, which again was the problem with 903s. One investor owned the majority of the units before we started selling them out. But the goal was to get it there. We had to start somewhere, so we helped when we got into those transactions. Limited risk full. So there we go. So full review, as I just said, 5 units or more, right? So limited is 1 to 4 unit condo complexes. And I use the wrong term overall. So limited is very minimal. Full review is that, and then you have a more in-depth view on higher than avenue. Get mine so stop looking at the screen. There we go. 5 most common reasons for condo mortgage ineligibility. And this is produced, this is as of 2025, data based on a sample of 1,000 condominium associations in multiple geographic locations across the United States. Number 1 is insurance. Right into that, as I just said. There's a condo in East Providence, and I can't remember the name off the top of my head. Their insurance for rebuild only builds it into the original format of how the complex was built. So, you go in the property, you have, you change out, you have granite countertops now. You redid your kitchen, redid your bathroom, whatever it is. The original way it was built, for mica countertops and that old bathroom things. That insurance doesn't cover that improvement. So now that improvement keeps them from being mortgaged. So that property isn't worth that anymore. If the house burns down, it's not going to be worth that money anymore because those improvements to the property help to increase the value and put it what it was. So that can play into it. There's one, I can't remember who they were too as well. I think they're right near the golf course in the park. I think it's the one right over there. I can't remember. I had a friend of mine who bought, and we were going around housing. We had to change everything around on it.
Is this the owner's policy that we're talking about, or the master policy?
This is association on this one. On that one, they had full walls and coverage. So they cover the entirety of it. So the homeowners association, so you can have yours is gonna state on it. You know, deductibles play into it on an HO6 policy. Again, HO6 is the buyer's policy, walls and coverage, and internal contents. They had it where they covered everything. Everything was covered there. You had your internal contents, that was it, your personal belongings overall. It would not build it back to that. It would only build it back to what it originally was. And they never changed it. They wouldn't change it either. We brought it up, and like, this is not a warrantable condo. You're not gonna get FHA. It wasn't FHA approved, and it wasn't Fannie or Freddie obligated into that. We did a portfolio loan directly for her, but she had to put way more down, right? She didn't have the opportunity of getting the grants at the time, which at that point, that was the $17,500 grant. The free Rhode Island housing money, that's what they used to do. It lasted a long time. It was great, right? You didn't have to sit there for 5 years on that money. You were immediately vested it. So you could refinance tomorrow and not have a problem, not to pay back. She had that issue.
What if they updated their particular unit to today's standards?
Well, that's the question, right? So anybody can do that now.
Right.
Your HO, if this one just happened to have it, it had to be rebuilt in its original style.
Right.
That's all they allowed for. Your HO6 policy is gonna have improvements. Capital improvements.
Insurance that particular unit,
Say that again?
you still wouldn't, let them get a mortgage on that particular unit, even though that unit was updated?
The
Or
update,
they have enough insurance to have it built as.
so they wanted to add on to it now, because it's overall for the product. I mean, that's additional on top of it, to that avenue.
Yeah.
It's still, the entire complex is the way it looks like that. Because, again, if there is a fire and all the other units have to built into that, now they're being rebuilt with the original product that was in there, so their values are going down, which means this property values, even if it's being improved, it's a whole. It's much like, when appraisal's done right now. They travel within a 1 mile radius generally, find very similar comps to your unit, what they're looking for, to come up with value. Now, the benefit on a purchase is we have a purchase and sales that says what we're looking for. It's pretty easy. The appraiser will look at that. If he doesn't come back with it, it's really, which is very minimal. About 5% of the time. But if he doesn't, then there's a problem. Property was oversold, something along those lines, more value than it is. And it can happen. You can also mess up, don't get me wrong. There's ways to go around that. But if he does do that, that property is based upon the immediate comparables around it and what their current values are. Same thing in the condo complex. They're just closer. And they look at other ones around the surrounding areas too as well.
So who discovered that the insurance would only insure it up to the way that it was originally built? How did you find that?
We did a condo questionnaire, so we had the condo questionnaire on it, and we got the master deck page, and it shows it directly in there. So there's things in there, the deductibles can play into things, if there's too much deductible for an individual, there's different avenues that, like the insurance has to be fully coverable. I think I have a slide here or some information on one of them about insurances and how they can become an issue. Let me see. But I had some addition.
Anthony, I don't know about your opinion, but
Roger.
I would say a lot of borrowers, when they come up with issues, it's usually they just have the problem with the HOA. I've run into it before, and it just kind of is what it is. You have to accept the HOA.
Mm-hmm. It's really coming down to approving the FHO, but they're also, it's their due diligence to keep up with current things.
Oh, no, I know, but I mean, when borrowers are having problems, it all usually comes back to whatever insurance they have in the HOA. There's nothing you can do about it.
Yep, and they're not willing to change it for the most part. And then the average consumer who lives in that complex isn't aware enough of what the gaps are. So they don't know to change it. They may be on the board for it, and they haven't made the changes to it because it's not brought to their attention. And these people aren't in real estate for the most part. Well, some of us are, that might be in there. But if you're not involved in it, and they're not talking about it, and discussing it, and then they can make the changes, because really they're working for the homeowners association.
So the seller probably doesn't even know that.
No, they don't.
It's potential, and especially if they've been there for a long time.
Right.
I've been there for an extended period of time. They're not going to know about all the things going on. They don't know how many how many lates there are for HOA dues. Like, there's rules against certain things. You have to be, I think it's 15% of the units can't be more than 60 days delinquent on HOA dues. Fees, like that could play into warrantability in a condo complex. I already told you guys about investor concentration. And that's the other, right? So if someone owns it and they have somebody else in there, they're not paying attention there either. They're far away, they don't live in the complex, they're not going to meetings, they're not getting, notification directly on it, that nothing is changing. And this is the hard part for it, because it has to be, condos have to be a community to an avenue, and you have to be aware of everything that's going on. Not just yelling that this one's parking at my parking spot the entire time, or this grass is too tall over here, or your dog's pooping all over my lawn. Which isn't your lawn, it's everybody's lawn, but it's still, like, these are the small issues that really they discuss. They don't really get into the nuts and bolts of the entire.
Is this similar for HOAs? Is that a whole different ballgame?
No, the HOAs, well, I'm not talking about the 1 to 4 units. Everybody's sort can be a member. So even on large complexes, the HOA association is the group of individuals that are there. The HOA company who manages it is completely different. So their job is really to pay attention to stuff, but they're not going to also know things that are going on unless the HOA association and the people involved bring it to the attention. And then, you got a bunch of people moving in the house. God, and who knows how old your roof is on your house? Anybody know? Top of the head? You're all realtors. That was a horrible. I shouldn't have asked you guys. It's bad on me. All the time, I think it's. Well, we've been here 12 years, so you got to start counting backwards and figuring out. If you tell me the condo's not going to know, they barely know when that is. And then you guys are getting the information too from the buyers, the sellers, and they're giving you what they think, but you don't necessarily know what it is unless you go to the HOA and find it out, or somebody keeps records. In the old school days was president, secretary, treasurer. Everybody handled everything. Everybody on the board. You had meetings every single month. I had an HOA in Coventry for single family, so we have one because we had a bunch of common ground I'd be taken care of. So right across from Hopkins Hill. So that whole area was a certain neighborhood that was built. All the common grounds were directly there. We got together as an HOA and put Christmas lights up on the apple trees that were in the front of the common area. We had cul-de-sacs and the whole thing. So all those grounds had to be taken care of. Those are all things that we discussed. We didn't have another management company doing it. We kept it in her. But they were all single, and we stayed on top of it. And we had a budget and a plan, and a treasurer, and a secretary. We didn't have to worry about roofs or insurances or anything like that. Although we do have insurances on the common ground, because someone trips and falls, that take care of them too as well. Whoever present this year. Next up. All right, let's continue on. Look at the other one. So budgets and reserves. Right, not enough money to take care of something. Now they're at a shortage. Now you have to start charging assessments. Now you have to collect assessments. Right? Those can all play into it. That's 22.65%. Deferred maintenance, critical repairs, like stuff immediately, right? Ice dams right now. Ice dams on condos. High-rise. They're not taking care of it. I've already seen problems. I actually saw a realtor post the other day looking for someone who takes care of roof rake. You can come and roof rake my property. Ice dams are collecting onto it. Big factor, especially right now. Right? Just get that first 2 feet of snow out of the way. Be much better overall. Fidelity insurance, as we talked about already, and then special assessments if they don't have it coming down. If you have a roof in 5 to 10 years, you're going to start collecting now for it, right? And in fairness, if you're collecting now for it in 5 to 10, that's not going to cost the same thing that it did today. Right? You're not going to lock in with the builder. You're like, no, you said it was this. No, I got it in writing. He goes, we had some issues. It's not going to work the same way.
Excuse me, what was the last one you said?
Special assessment.
Special assessments. So anything needs to be done. Paving. Lawn care. Something like, if you have to change stuff out. Not as much lawn care, but like the paving has to be done over time. Cracks cause damage to your car. Those are private roads, right? So those things are going to be, you start going through, you bust a tire directly on it. If you go for the state or the town, you can go to the town and ask them for money. You show them evidence. You don't always get it, but you can do. You can do such. On the crossing, the complex owns that. It's usually private property, right? All the roads and everything else are the responsibility of them. That's why they have their own companies come in. And I know in my complex, they got these 2 little excavators just driving around 2 o'clock in the morning. Really cool. Horrible though at building up snowbanks. Right? There's nothing to lift it up and push it back overall. And we're surrounded. Like I said, I'm in Lincoln. I'm in the way Providence in Lincoln. It's all surrounded by woods. There's a drop off on one side. They can just dump it into if they don't. It's not there. but that takes up a parking spot. I gotta park crooked, somebody else skids into me, it's always an issue. Put up way too much sand on everything too as well. It's tracking into my house, it's hard. It's hard to keep a blue suit, stuff all over you. Take care of it, it's hard, it's very hard. The special assessments was the last one. So master insurance policies. Their coverage levels, perils listed and covered, like fire, windstorm, water damage, and other common risks to ensure broad protection of the for the property. Florida, completely different, right? Florida has wind, hurricane, all these other things. We got other centralized areas have tornado. They can still play in it. These can all add to. So those have to be covered directly on there in order for it to be in that warrantable category. Limitations of deductible, 5% max. Right? You can't do more than that. You start doing more, you're reducing it, changes it. I actually don't really understand the reason why that plays into that. But deductible has always been a hard set rule. Right? It's more than 5%, they need to lower or change it. And they're not willing to do it. Like I said, the HOA is not going to change it. Like the HOA management company is not going to change that. Replacement cost basis required. Right? What it costs to replace. And your appraisal on that property is going to tell you what the replacement cost is, and it has to be within line of what they're replacing for, either one of the units or the overall complex. If it's not, then they're undercutting, especially in the last couple of years. You've seen insurances have skyrocketed everywhere. I think it's 33% increase, but we've also had a lot of insurance companies leave the state. Don't know why. We don't have hurricanes or anything else. We had a flood 10 years ago. That was pretty much the biggest issue I think we've had, but for whatever reason. But Brown's also the only state that actually has an arson disclosure in all their disclosures because we burnt stuff down back in the 40s and 50s and just rebuilt. So, but it's so bad that we have to have a disclosure, and then it tells you, you ever committed arson? No. Has the other person? They asked on thing just to make sure they're being truthful on it. It's hilarious, but it's a reason for having that because it was an issue. So arson actually is a big factor in Rhode Island on insurance policies too as well.
What is it, cultural?
I mean, your Fox Point and certain areas, things happen.
The restaurants seem to be going up a lot
A
recently.
lot of restaurants, right? A lot of restaurants are going up recently.
My marina went up?
Yeah.
I don't know.
That might have something to do with you, Joe. What are you doing?
It was the marina with the, I'm not gonna.
Joe had a boat that actually got pushed away. What was it? The boat that flipped?
Oh, the mooring that broke?
Yeah, the mooring that broke and your boat flipped?
Well, no, it just got destroyed on
Yeah.
land.
Yeah.
Yeah, no, this is this. Why do we have to go to me?
Joe and all that things, Joe's my bad guy. I used to play pit against him on a regular. So at one point we did a class where we did scenarios, and he was always he was the landlord. That was awesome. So much fun. We're gonna do that again, Joe.
I'm
That's a great idea. So actual cash value not allowed. Property must be able to be fully restored after loss, fully to what it was before the loss. So like I was just saying, those countertops are changed. The policy doesn't cover it. That's a problem, right? It's not worth what you paid for it at the time, or in its current market, it might not be worth it anymore. So now you could be underwater, which is the same reason why you don't see a lot of 100% financing loans anymore, right? Because really it's 2007, 2009 is the reason for that. We used to do 80-20 piggybacks. First, second mortgage, no PMI directly on them, 100% financing covered all the time. We don't do that anymore because property value swept out underneath us, killed us. And then all of a sudden you had all these properties and then people were like, well, no, it's not worth it anymore. I'll just foreclose. And then wait a couple of years. I think it's 4 overall, depends on the thing. Wait a couple of years and then just get another house. That's it, just walked away. So everybody walked away, and that's why the market undertook, because we had 500 million foreclosures in like a 9-month period of time. So as soon as those foreclosures happened, that's all those houses flooding on the market. Now we have too much. The same thing as eggs, right? The eggs went bad, and then eggs were like $10 for eggs. What happened? Shortage of eggs. Worth more. It's what you're willing to pay for it. So if you got too many eggs, oh, we gotta get rid of these eggs. Sale, discount, let's go, right away. And that's what'll happen. So same mindset, you'll be playing into it. Reserve fund, we talked about, right? So risk mitigation reduces likelihood of special assessments, increases property values, financial health indicator. 10% of the reserve guideline may disappear, and reserve studies becoming more prevalent, legislatively required, impact to insurance costs. I actually have a follow-up for this one. So I can explain that better. Insurance is about risk mitigation, right? right? It's taking the liability off the individual, putting it on, off the major backer, putting it on the individual. So if someone pays for insurance, they're reducing the risk on the investor who has the most amount of money invested directly into it. Financial reserves serve as an association's self-insurance for all non-covered expenses and the hefty deductions that play into it. Fannie Mae requires that the association allocate at least 10% of its annual budget into replacement reserves, at least 10%. Freddie Mac also emphasizes strong reserve fundings, allowing less than 10% only if a recent professional reserve study, which is a new thing, it started recently, they're becoming more and more prevalent, but a professional reserve study was done to support the lower figure, and the association is actively funding based on the study's recommendation. So to give you a mindset, a reserve study on these associations is simply an assessment of the association's assets done in an effort to keep the reserve fund at an optimal level. It typically involves an on-site inspection to calculate the estimated remaining life of common elements and the estimated cost of repairs and replacement items. Reserve studies consist of two parts, namely the financial analysis. This examines the association's finances, such as the income and expenses. It also takes the current reserve funds into account. And then the physical analysis. This examines the physical condition of the association's common elements along with the estimated cost of repairing or replacing them. Overall reserve study is essential for maintaining the financial health of the condominium association. Adequate reserves funding proves to the GSEs, the government, Fannie and Freddie, that the association can reliably pay the maximum 5% deductible without instantly putting a crippling financial burden on its owners, thus maintaining the project's financial stability and warrantability. So that's really why, actually, I do know why. So the reason why it's left at 5, the entire complex burns down, they're gonna rebuild it, they have a 5% deductible. If your reserves aren't there, you can't build it. Now you have nothing. Florida is a great opportunity. The hurricanes happen, right? So I just came back from Florida, and I saw all these properties on the west coast of it, and they just raised them. They didn't even bring them back, right? They didn't rebuild them. There's lots. The lots of $1.2 million because it's on the water, right? And all these little things over there. It's gorgeous. But all the houses are cinder block. And now they have new requirements overall on how they're rebuilding it, so everything has to be built up. And it's a big garage on the first floor, so you can't have anything on the first anymore. Anytime you're rebuilding in Florida, the new requirements are your house is basically on stilts from the second floor up. You have a garage on the first floor, and that cuts liability directly for the full repair of the house. If the house is flooded, everything's got to go, right? Anybody ever seen a house that's got water damage? Everything's got to be cut down to the boards, to the studs, and even the studs could be replaced. And there's new structural problems, so the same thing would work. If it's coming down and that deductible's too high, they don't have enough money, they haven't been saving for it. Then that's going to create a financial impact on that association and will affect all the rest of the units directly in it too. So that's why the 5%. And then these new analysis are coming into play, which is really just a major budgeting review on it, okay? If you have more than 5 units, the HOA managers are paying more attention to that now, to that avenue, in order to take care of that. And it's really because Florida, that condo that fell down. That's what played into it. So all that deferred maintenance, all those other issues, and which is why lenders are paying more attention, or Fannie and Freddie mainly, are paying more attention to deferred maintenance more than anything else. Because if you don't have enough to be able to take care of those over a short period of time, then that happens. It's horrible. It's remarkable to me, a place with a pool on the roof was not taken care of over the entire life of it. And it was overseas the ocean, so they weren't inexpensive units. It was a pretty decent place, and I think the HOA dues were something ridiculous, because they have wind coverage and stuff like that too as well. This didn't even cause it, it would just trickle down overall. I think the pool had something to do with it. I think the pool was leaking down a side, and it softened everything on a side, weakened the entire structure, and then it fell to the ground. Deferred maintenance in critical repairs, structural and mechanical component conditions, potential safety risks, financial instability, reduced property values. We've talked about this a couple times. That's this one. Fidelity insurance. So it safeguards associations' financial stability. Financial controls required. 3 months of assessments on all units and must cover all reserve funds. So we're going to go through this too. So Fidelity insurance for condos, also known as condominium association fidelity insurance, or simply condo fidelity insurance, is a specialized insurance policy designed to protect condo associations and their members from financial loss resulting from theft, fraud, and dishonest acts committed by individuals who have access to the association's funds. Anybody here is a part of any charitable organization, or even, I think we'd have them too as well. You have a fidelity insurance bond. Your treasurer steals money, it happens, this is Rhode Island, it's happened. So there's rules against it. If that comes into play, you're gonna have a financial hardship. That financial hardship on condos plays a lot bigger because you have all these other units that you're taking care of too as well. So now you're losing funds. This is in play so that they make good decisions, not just that, but also with how they invest the money, if they have any reserves accounts, how it's held, what it does, make sure there's not major losses directly in it, and protects them because someone can go directly after them. So they come into big play in order to maintain the funds it currently has and not to lose. And if it does lose, this comes in, kicks in, takes over, refunds it back, which it shouldn't, but for the most part, there should be vetting processes in order to do it. But everybody goes through something in life. The average person, I think, even the government situation is interviewed excessively to make sure that they're not that they have no financial issues. Because something like that happens, people make bad decisions based upon a need that they have, and they can transfer it over.
Anthony, is this a requirement to be a warrantable condo?
Yeah, it's part of their regular. They usually have it on either a bond or fidelity insurance directly there. The association or the association and the condo managers both have to have them.
And this is separate from your master insurance policy?
Correct. Yep.
So you have to ask for the fidelity insurance?
Well, you guys don't have to ask. We ask when we get when it comes back with the condo questionnaire.
We're gonna be prepared so
You are.
that when you ask.
We'll discuss that. We'll
Okay.
get there. We'll get to that point.
Okay.
So those are questions you ask. You guys, really, you don't have to get at that point. Now, during the process, it's going to come down. A customer's obligation is always to pay for whatever the condo. And I've seen fees of $100. I've seen fees of $500. It's a lot of money just to do a checklist and then provide some docs, which are in PDF now and it's transferable over. It's really not that. It's not like the old days where you had to go down to the city hall and gather all the docs, get all these, bring them in, and then someone had to leaf through them the entire time. It doesn't happen anymore. Everything's right there. You can control F to search for different things. Fidelity, boop, goes right to it. All set. Not a hard thing. We'll go through some streamlined process in order to do that. So according to the Community Association Institute, approximately 24% of community associations experience embezzlement or fraud at some point in their history. The CIA also reports that fidelity insurance claims can range from a few $1,000s to millions depending on the size and financial activities of the condo association. Having fidelity insurance in place can significantly reduce the financial burden on individuals and owners for covering losses. Unlike a condo's operating fund, a reserve fund can be set aside for investment opportunities. So you can, the special assessments, everything else, you can actually invest those, try to turn it into more, invest in the market. Right? It's still an issue, but if all of a sudden they put it in Bitcoin, maybe they didn't make the best financial decisions. And that insurance can play into that too as well. Might be able to help them. You know, I got an alpaca farm down in Coventry. I've invested in that heavily. It's gonna do great. We're gonna get socks and sweaters, we're gonna have a great time. All the alpacas passed away. It was a bad idea, guys. Didn't work out. That's bad investing, right? It's a financial planner, good group that could do that, but some people do it on their own. You know, they're on Robinhood, investing in stock and trying to do penny stocks and be like, oh, it's gonna be big, and then it just dies. So these insurances cover for that, because as soon as that money's gone, there's a massive burden on you. It's gotta come from somewhere else for your assessments, for your issues, for your fixing, for even your general operating costs on a monthly basis. All that goes into play. The lawn side, you can't pay the lawn guy to come and take care of all that. The lawn side's coming up, property value decreases. Right? It's all keeping up with it. That's why HOAs, for even the properties, have rules set in stone, because they don't want the one property, like there's a lot of them now where they have no cars on blocks, no boats in the front yard, no RVs, because those things sit there and they deteriorate over time if someone doesn't take care of them, and then all of a sudden that property drops value. And then all the other properties lose value behind it. That's why those rules come into play. Now, hard, if you go into it, I mean, if you look at it when you move it in, like I moved in my condo, I looked at I also wanted to know all the rules. So I could be like, nope, that's not the rule. It's right here. I can park there. It's my spot. You gotta know, right? Be the smartest person in the room, you know when you're done, like me. So as long as you know those going into it and be ready for it ahead, there's always gonna be complications down the road. There's always gonna be somebody butting heads or their opinion on it and something like that. But as long as you're aware and following within those ranges, you're fine. In this case, they're not. So they did something, know this is gonna hit big, it's gonna double our money. Now, as a condo owner, I won't have to have as big an assessment to replace that roof. Someone's gonna try to do that. Now, I bought Powerball's up to $353 million. I bought 1 million tickets. That's what we had. Let's go. I'm trying to turn it over. Small investment, bigger return. Doesn't always happen. Why not? That's it. Special assessments. Hey. Litigation facts. Special assessments may be current or planned. Lenders must obtain and review the following information for each special assessment to determine if it addresses a critical repair. So again, remember, deferred maintenance is the biggest factor. It's things that were neglected for a long time, people haven't been paying attention to it. This comes in, special assessments are there to help that out. What's the purpose of the special assessment? When was the special assessment approved, and is it planned or already being executed? What was the original amount of the special assessment and the remaining amount to be collected? And when is it expected date of the special assessment being full? It's a great question for you guys to ask when you're going to list a property, right, and going to find that out, because has anybody ever had a borrower had to go to closing with $10,000? Newer complexes make you do it. They want to build up those funds, so brand new condo complexes usually we haven't built up our assessment fund. So every new person that's purchasing has to bring in additional funds. So the down payment, the closing costs, their escrows, their prepaids, all that stuff is taken care of, but then they have this additional cost to themselves. And they're not going to be aware of it until some point. You know, it's finding that information out. Usually the builder's in charge of that property at that point. He hasn't turned it over, which is a whole nother issue about warrantability too as well. But when they're in charge, when it's not the association in charge and it's an individual or company, it becomes an issue. But that's a massive thing to make your sellers or your buyers aware of. I mean, the sellers are fine. It's good to build at this point, but the buyers need to know that. Right? It's good to know. It's tougher on the side of the buyers of you gathering the information. It's easy to get it from the realtor, but having that information for them, providing it directly to them, can help them down the road. I've seen deals not be able, we don't have $10,000. We use it all here. And we can't change this loan over. This property is not warrantable. It's still in the bill. It's the first unit being sold became an issue. So the deal died, mainly because information wasn't provided beforehand. That's a simple one to figure out. They're building it up. It's also helpful to ensure that reserves are adequately funded to circumvent the necessity for additional or special assessments, which could lead to heightened scrutiny regarding the condominium's financial eligibility. As I said, it's financial stability, financial strain on borrowers, inadequate reserves, critical repair indicator. Repairs funded by special assessments must be completed and negatively impact unit value. Favorite one, litigation. So, problem with most condos, and it could be for a lot of different reasons. There are a lot of reasons, but pending litigation against the condo complex is a problem, because it eventually could lead to loss of the reserves they have, which then could lead to them not having enough, which could lead to new special assessments, which can decrease property value as well. Projects are undergoing pending litigation where the HOA is named the party, or where the project sponsors or developer is named in relation to the safety, structural soundness, and habitability or functional use of the property. It messes up, significantly impacts the lending availability, the financial instability, the possible future special assessments, as I said, construction detected, defect pending or active rendering lending unavailable, and any suits filed against the association. So there's a lot of different reasons. I've seen people, they didn't pay their HOA dues, so putting a lien or doing that directly on the property, and then there's litigation directly on it. Or these neighbors hate each other, or this guy wasn't being nice, or the HOA wasn't being nice to that. People sue and have that outside. There was one that had Cranston, I think it is, overall. I think it was a Purcell neighborhood too as well, condos that did it at the time. And again, I don't have anything against Purcell, I just remember it being for that reason, because things happen across the board. But they didn't finish the roads and never had anything directly for it. And they were the builder, and the litigation was basically against them at that point. And those condos became unwarrantable. I had a friend who owned one of those. He was trying to go through those. I sold it as a cash deal, got rid of it, didn't have any problem. I mean, none of this really matters on a cash deal, but you're not really protecting your buyers either, or your sellers. So he sold it cash, moved out, and bought a house directly for it, because literally it stopped at one point, and all this other asphalt was never done. It wasn't projected for anything else in the litigation between the two. And it went on for a while, like 4 years or so, something along those lines. It was really bad, and it's right in Cranston. It's the main complex.
Great coach.
I forget what the complex was. There's a lot of them. They all melt together at some point in my head.
Yeah.
Additional.
I think Gray Coach had an issue with one of the buildings was getting settlement cracks, so those owners were suing the whole complex.
There you go. So why would they do that? Because they didn't list deferred maintenance over the time. Now there's an issue on it. So now all their property values are out of order. Now all their property values are going to decrease based upon that because they weren't able to pay attention to this thing. Oh, there's a crack. Maybe we should look into it. Maybe we should have a structural engineer come look at it. HOA didn't either. The funny thing is, I know it's the unit owners who are doing it, but what were the unit owners doing? You didn't notice this at all? I mean, maybe it's something that's hidden, right? Maybe it's there. Maybe it's in the basement area, they didn't really notice it, and the property started sinking, stabbing. That's possible. But it's on their obligation, because they still have meetings, they're still looking at stuff. And then bring it to the attention of the company who's not even there, only comes to your meetings. They're not walking around the property. That's why those reviews are important, because it's asset review and physical review. To look around and see if any issues. It's a regular, recurring thing, and now it's just a business expense. It's another.
Well, while that was happening, I had a lot of buyers that were inquiring about condos that were for sale over there. I'm like, unless you're paying cash, you're not getting it.
Yeah. Yeah, and even then, like, if you want to get that, they just know you could probably have problems down the road. Pay cash, it might not be worth it. This could be a problem. It could be for, condemned. As a matter of fact, especially with a structural issue like that, it comes right down. So additional warrantability issues. Comprehensive master policy does not cover fully improved property replacement costs. We've already talked about that. Right, so it's whatever it is to rebuild it as it was. If it doesn't cover it, that could be an issue. And if they haven't had reoccurring things, they haven't had reoccurring reviews of that like every year to see if that changes, then that's going to come down the road and be an issue. Unit ownership in a complex, 5 to 20 units, no owner can own more than 2 units for Fannie and Freddie. So no individual owner can own more than 2 to be warrantable. 21 plus units, no owner can own more than 20% of the units for Fannie, and no owner can own more than 25% of the units for Freddie Mac. So that would be the option. So these are questions, like I said, that you can find out beforehand. And you're gonna have to, maybe you have a good unit owner who's on the board or knows stuff. If not, the first step, find out who the HOA is. Get that information. That's great as a selling realtor to know that, to be able to give, because we're gonna need to know that in order to contact them to get the condo cert taken care of. Know the HOA association is, telephone number, email address directly for them so they can be contacted. Then start asking different questions. How many of these units are owner occupied? How many of these units are, and a lot of times they might not give you that information because they want to get paid for it. And you can go online and get the standard Fannie and Freddie form if you really wanted to and provide that to them if you wanted to get that beforehand. And you can list it in your disclosures when you're listing the property. Have all that stuff on there. This is how it is. It'll help to keep the file going and not slow you down later on. Owner occupied ratio under 70%. So if it's not 70% or 70.01% or higher owner occupied, it would fall in that category too, become non-warrantable. HOA dues delinquency, no more than 50% past due over 60 days. It's a tough one sometimes to do, especially if there's assessments too as well. That comes into play. Property type cannot be a condo tel. You see those? Go down to the beach, long spread, try them all in the condos. Condexes, fine. Everybody knows what condex is. 4-unit property that was turned into individual condos. Condex, right? Those are usually, those unit owners own the entirety of it. They're the HOA. They make all the decisions. They get a joint policy on it. It was converted over at some point. It happened a lot in the early 2000s, where you had all this multifamily properties, and they started selling them off, rezoning it as a condo, getting it all, and then selling each unit because the 4 different units were worth more than the 4-family property. So it was just a way for them to increase their revenue on it. Can't be a condo, I said, a hotel-style project or a full or manufactured house. Can't be a manufactured. I've never seen a manufactured condo, but I'm assuming there is, because this is a rule. So it's gotta be somewhere. Commercial or mixed-use space. We talked about this earlier, someone else asked. Can't have more than 35%. Or first floor is all commercial space, not a problem. Not a big deal, as long as it's less than 35% of the overall building. Recreational leases. Required mandatory membership to pay dues to third-party organizations, golf courses, or other recreation facilities. A lot of times if they're on one of those, and they're part of that more vacation home kind of thing, timeshares kind of mentality, and that can be an issue. That's usually a business as for the way they're managing it. If they're selling off units individually, it's one thing, but still it's gonna be probably primarily owned by a business that owns the timeshare or the company itself that's managing and organizing it. We don't have a lot of that here, but like Florida, other places, anywhere there's a golf course really, like warm golf courses, not cold, not right now. As I said, master policy must be able to rebuild in its most recent form, including enhancements or renovations, not to its original construction form. Unit ownership to avoid risk concentration. No single individual entity or investor can own more than 10% of the units in the project. This ensures that no party has disproportionate control over the HOA or market prices within the community. So it actually keeps, if you own more units than that, you would have a bigger say overall because you're like, I have a bigger piece of the pie. I'm 10% shareholder of that avenue. That's what they sort of, so it keeps them from being, it's more fair and unbiased directly on all of them. The owner-occupant ratio, residents are often better maintained than rental homes, which protects the value of each unit and the value of the complex.
Does that apply to up to 4 condos as well? So like if 2 are owner occupied and the other 2 are rented, it would not be warrantable?
So it could be not looked at the same because it's a full review usually under 4. It's just a master policy making it show that way. So it's really not looked at the same exact way.
Okay.
Because someone can own 3, have it that way. But there's, if it's, I'd say if it's discovered, it'd still become a concern. Because then, you know, if you have 1 unit overall, someone's owning the other 3, he does whatever he wants, he or she does whatever they want. The other person is sort of limited, a liability, and then they get out real soon. Why is Lisa smiling? You had a big smile on your face. You got I thought you had a good story. I thought you had a good story. Resources. So here's your approved condo list. Oh, look, condo question list right there. So approved condo list for VA and FHA. They are approved. They're required beforehand. It's a process. It costs money to do, but it's worthwhile for the complex to do it, and also can learn what their problems are if it's not. So both those websites, and actually on this thing, it's actually a click button. Sorry, should have put the whole address up there for you guys. Condo questionnaires, Freddie and Fannie, you can just go look them up. They're right online. You can have them at any point. If you wanted to utilize that as a resource, hand in, ask someone to do it. If you want to pay the funds, consider a part of your fees for doing the work that you're doing, feel free. The more information that you gather in that, the better, right? It's much easier to get it out of you, figure it out.
Can you require the seller to have that?
We can't mandate it in that avenue, so we can't push somebody on it. It's a requirement for the individual buying the property, not necessarily the individual selling the property. So I can't just say, well, you know what, we're not gonna lend to you because the seller didn't provide this. You should do it.
Sometimes the condo association in the documentation, in the portals, or if they have portals, they'll have a lot of these documentation in there, like the insurance policy, you know, the HOA do set up the, just all sorts of different policies. So if you talk to your sellers, right, ask them to go into the portal, try and pull budgets, try and pull the stuff because a lot of it's there.
If you need those, depends on how much of a review you're gonna have.
The questionnaire won't be, but
No.
the budget will.
And even then, a lot of these HOA major companies now that are managing, and there's a couple of them, there's like, I think like 7 or 8 in the state that have the majority of condos. We're up there, they will send a condo questionnaire in, they'll send back an email which is like 4 answers for. I'm like, what did I just pay $300 for? What was the point of this? It didn't really help me at all. I still have more questions. Are you gonna charge me more? Is this like a subscription? I gotta go pay more in order to keep going for you guys? They really are, they nickel and dime to some avenue. Apologies to anybody who works for one of them.
So Anthony, this may not be relevant, but condo conversions,
like a
Does
condex.
those condo questionnaires, do they have to be completed if someone is in the process of, or a developer is in the process of a condo conversion?
So like, for instance, what's the location of
Some
Warwick?
mixed use,
What's the one in Warwick that used to be the place everybody got married at? They're converting all of them into condos over there, right? The West Valley Inn. So West Valley Inn is converting that whole entire unit for condos, and it's taking forever because I had a customer who was pre-qualified a year and a half ago, and the property should have been done, and it still hasn't been completed yet. But she had issues; she ended up not doing it.
The West Valley has
Yeah.
been done.
But there's certain units that were going, that were being done at the time. This isn't now. This is end of last year, during last year. She was even a year before that avenue. They don't need them to do that. Like, they're gonna go and the conversion is gonna convert over, right? That doesn't really matter.
they
There
don't
is an
have to
issue.
go through this, that questionnaire.
There can be a concern of if someone who's buying it directly, so the builder can still be in charge and own the whole thing, right? Therefore, one person owns all the units at that avenue. It's a lot of problems with that. That's why it usually has to go warrantable, non-warrantable at that point with the lender.
Okay.
Because you wanna get the first couple in there in order to change it over, and then it starts changing, and then eventually he has to hand over control of the HOA to the association, whoever it is. He can't be in charge of it, he can't be the association. But on the construction phase, it's tougher because it's new. But usually they have backing, whoever's backing them, a local bank is usually backing the construction for it. They're gonna be first in. I've seen the ones in Smithfield, across 295. That's 55 plus community, specific to that. The lender who helped them back it was the first one, so the realtor was pushing that directly to them, sending them over there. They were gonna approve them based upon that, and they were gonna be in-house, non-warrantable condos and hold it that way. Right?
So if a listing agent proactively pays for the questionnaire, is the lender gonna go back and say, well, we need to do it ourselves, we need to hear it from
If
them
it's an
directly,
actual,
or yours is too old, yours is more than 30
It
days
is
old,
gonna
so
matter.
we need to redo it?
so time frame will matter to some degree. 30 probably isn't gonna be an issue. It's gonna come down to the lender and what they want. Most things have to be ordered third party, like appraisals, for instance. When you order appraisal on a property, the lender doesn't order it directly. You have to order it through a service who just farms it out and does whatever it is. So we can't have any influence on it. And that's why. That's what you have to look at. It's about influencing and committing fraud or something. They don't want that directly in there. Title's a little different because title's an attorney. He's supposed to be the bar. He's supposed to have a good mindset directly to him, so it's perfectly fine. For the most part, I think it'd be fine to get away with it, unless there's things that were not added to it and not bar. That'd be the only one. Any other questions?
No.
So ask questions, like units, occupancy, master policy, how it is it walls in? Not, if it's not walls in, it's better. It's better to the avenue because your buyers are gonna get their own policy and they're gonna be up to date because the lender's gonna make sure that it's a correct policy. Do that. Any others? Go ahead.
Does the questionnaire include the annual minutes, because sometimes that can.
No, but if you get, so annual minutes are really important, but not just annual, but meeting minutes
The annual.
are important because they'll discuss deferred maintenance in there, if they're doing it right, and then you can find that information out, then you can figure out how much deferred maintenance the property has, make an assessment based upon what's necessary, then look at the assets to make sure it's taken care of, and which is regulation. It's only like on a full review, that you're really gonna need that, but we still sort of ask them, like my condo, my company will tend to ask them overall, just so we know more as we're going in before we make the decision. Any others? All right, perfect, thank you very much.
Scott, approval, please?
I'm sorry?
Like, if it's not warrantable,
Yep.
and it is one particular unit, they do it sometimes it's spot approval.
The lender will make that
Yes,
decision.
yeah.
Yes, lender, so a non-warrantable condo, a lender will actually make that, and there are only certain lenders, like I said, most of them are local, homegrown banks. There are a couple, I've seen a couple other companies, some non-QM companies that do non-warrantable condos. But when they're doing that, they're also they're gonna charge. It's gonna be, their rate's gonna be higher, right? So like for Washington Trust, when we do it, it falls within our Fannie Freddie rates and wherever they're at. But you have to evaluate the property still and see what kind of risk is gonna be directly on that investor. As the investor who's putting the funds up, to make sure it's warrantable, and it's not something we think in the long term is gonna keep and depreciate property value. They have set guidelines and rules, right, that how they run, right? We can oversee that, I mean, if somebody has 10% ownership interest in their property, that might be something we're fine with, right? Or if, you know, the woman who had the insurance, we did fine, we actually made it, we did it because we made sure she had her insurance policy, she had to get additional HO6, so that she would cover the interior to be rebuilt as was, because the master didn't cover it, so that's what we did, right? They're pretty set in stone where they are, it is, no, not doing, but the lender can make that determination based on how much risk they wanna take on. And even then, there might be limitations on how many units they wanna do in that complex. Because if you find out that they do it all of a sudden, now everybody's like, oh, I know Washington Trust does, let's go do this. But they don't wanna have 80% of the units tied to for us, our deposit accounts. Of how we lend money, it's from our deposit account, back into the community, into lending, to help someone get a house. If we're utilizing that and all that, then we've increased our risk even more than more and more loans that we do in that complex. We'll do a couple, there's no limitation number.
The buyer is paying the higher payments or closing costs would be higher?
You, like on one of those non-QM, non-warrantable condos, they are. Their rates are gonna be higher. So that's mortgage rates are based upon layering of risk, right? Credit score, property type. Condos actually usually have higher rates than single-family residences. By a very small amount, right? It's the next tier up. Multifamilies have even higher rates because it's risk layering. So everything, it's like having life insurance and you're a smoker. You pay a higher premium. That's how conventional mortgage rates are based upon. It's based upon 6 different factors that can play into it between your FICO score, your credit score is lower, you're higher risk, right? The property type, the occupancy, an investment property, you're more likely to give up your investment property if you have a hardship than you are your primary residence. So risk factoring all plays into rates and how it's when done. This plays into it, those lenders will actually increase it too because they feel they're taking on more risk, they're not local, they're not around, so they'll do that and the rates are higher. So if the rate was, just for an instance, and not 100% accurate, but let's just say they had a rate was 6% today for conventional, right? They might be 6.75 because that 6.75 is alleviating their risk because they're making more overall on transactions to try to alleviate it. And that's how
That's lifetime of the mortgage.
until they refinance. If they find another lender who will take that condo unless they fix the problems.
I was not aware of that. I thought it was the individual bank where lender was taking that risk and thinking that it is safe to go forward with this particular buyer, and they are doing that for that particular buyer.
That one doesn't, so Washington Trust, for instance. Washington Trust goes in, we see the property, yeah, we'll give it as current rates. But outside sources, outside lenders, outside the state, we usually, like Joe and I say, non-QM, which is, it's not subprime, but it's a new variation, but it validates everything. So they do their due diligence, there are decent loans. You don't meet, so non-QM is basically, you don't meet regular Fannie, Freddie credentials that everybody follows, and you go to these other programs. Now you're paying a higher risk because of that, because you don't meet the regular requirements, higher risk overall adds to it. So a non-QM might have a higher rate directly on it. A local bank, or like Washington Trust, has the current FHA, Fannie and Freddie rates that they'll utilize, and that'll be life of loan. So if it's 6% right now, it'll be 6% life of loan, unless they refinance, and they can refinance again with the same lender. If rates got different, if rates went down to worthwhile, which is usually more than a point, it's only beneficial when you have that, then you can always refinance with that lender. But
There's no prepaid penalty.
no, none of those. Non-QM sometimes have, Joe, right?
I think it's legal in Rhode Island.
Yeah, it's overall. I think
They can have them, but I'm pretty sure all my programs,
Yep.
I think it's illegal in Rhode Island. On investment properties, illegal? Yeah, I think so.
I think so, the overall. All right, any other questions before I finish?
I guess you asked.
All right, commercial time. Look, Anthony Ambrose is the speaker today. Upcoming events for Kent, Washington. Breakfast membership meeting at the Carriage Inn in North Kingston on Tuesday, March 5th from 8:30 to 12:30. We are also offering a 3 CE core class on risk management for real estate professionals at this meeting. So you can stay at breakfast, at the meeting, have the core classes done. Price is $25. It includes breakfast and the CE class for anybody who's in need. On March 12th, we have a FinCEN class, which is a reporting requirement for certain closings, financial reporting requirement. There'll be a sign up. We'll be sending that out, I'm sure, in the email, so you can sign up directly online. And then I gotta let everybody know too as well, we are a drop-off site for Project Underwear, for underwear, socks, and a diaper drive for February. So anybody who has them can bring them into the office, and we'll take those and then provide them to the charity, and do it that way. All right? Thank you all for coming. Look forward to